Welcome everyone to my Q4 quarterly conference call. Thank you so much for joining. I'm Heloïse Greeff. I am the founder and the person behind the Rubymza portfolio on eToro. If this is your first time joining, the agenda for today for these calls are a brief introduction to me and the portfolio, market, as well as a portfolio review for Q3, which is the quarter that is just passed. And then we'll do a market outlook for Q4, which is the quarter we're going into, as well as how the portfolio has been positioned to take advantage of what kind of my perspective of the market is going into the next quarter. So I have over 175,000 followers on eToro. I've been a popular investor for a number of years now, and over that time, I've had over 20,000 copiers, and more than $50 million of assets under copy has passed through the portfolio at various points within the last couple of years. I also have been featured in a lot of media outlets and recently joined the Popular Investor panel at the Global Summit to sort of speak to other popular investors about how they can sort of manage their journey as they grow their copier base. A brief introduction about me. I am originally from South Africa. I came to the UK, specifically Oxford, as a Rhodes Scholar to do a master's and an MBA at the University of Oxford. I then later came back to do my PhD in machine learning, and I have a couple of patents and publications during my time at the university. In July this year, I announced that I have become a full-time popular investor. And yeah, I've been spending my time not only managing the portfolio, but also working on developing a number of different exciting projects that I will go through during the call. So my investment strategy, and I do apologize if you've seen this before, but I do think it's a really important thing to talk about, because we do have to remind ourselves what we sort of signed up for when we copied the portfolio, or even myself when I started the portfolio. It's really important to review that, especially as the economic environment is changing. I get a lot of questions about why am I not doing this? Why am I not doing that? And so hopefully if I review the sort of investment strategy, that will help to answer some of those questions as to why those particular tactics may not fit into my specific investment strategy. So just to remind you that this specific portfolio is a long-term equity portfolio. The portfolio is net long in most of its positions, although I will talk about some of the short positions in the portfolio. We focus on long-term compounded growth, and I use risk management to try and reduce the volatility, because this is a moderate risk portfolio. So I do try to keep the risk score on eToro between 3 and 4. In last year it's gone up to 5, but that is sort of the risk score that you can expect from this portfolio. And then it's based on a lot of strong fundamentals that I use to interpret the economic environment. Sort of second layer to that is what I would consider is my unique perspective, my unique background. So I do use bespoke machine learning algorithms, which I wrote a couple of years back, to do some of the technical analysis. Again, that's just because it's my way of viewing the world given my background, but that does not mean that this is a sort of robo portfolio where all the positions are executed automatically. I would reiterate that I do just use those algorithms as sort of extra data points to help inform any decision that I do make about whether I want to have a particular stock in the portfolio or not, but also more importantly about when we remove it from the portfolio. Secondly is using the sort of environment that I'm in. So that is using the eToro platform, which has 0 or low fees and really empowers transparency and responsibility in managing investments. And that's something that I talked about just last week at the Wired conference. That's so important when we are talking about disrupting financial services. And then finally, something that I've been quoted for in the Bloomberg before is the use of my analysis of the hive mind. So those are the social aspects of social media, but also the eToro social feed, and seeing how we can analyze that as an additional data point to sort of get into the minds of the retail investor and see what the sort of long-term trends we could be anticipating from what people are talking about and what they're discussing. So how has that sort of served the portfolio over the long term? I started my portfolio, I joined eToro in 2016. If we consider starting a portfolio at the start of 2017, so it'll take whole years, the S&P, which is the benchmark for most of us on eToro, over that time has performed like this. And up until yesterday, when I calculated this, you would have gotten about 1.7 times the return. So if you put in $1,000, you would have $1,700 as of yesterday. And the important thing about this is also the smoothing, because we are currently going through an economic downturn. But the important thing about a long-term portfolio is to remember that this sort of smooths out over the long term if you kind of ride out these different up and down cycles. So if we add the data points for the Rubymza portfolio, we can see that over this long-term period, the portfolio has returned almost 2.5 times the original amount. So if you had put the same $1,000 in this portfolio, you would have nearly $2,500 right now. And the reason I show this is because I want us to remember the importance of long-term trends in a long-term portfolio. And long-term, we're talking about 5 years or more. And when you're constantly compounding the growth, you do see the sort of pulling away or almost exponential growth of the portfolio over the long term. And that can be really easy to forget when we are going through a bear market or economic slowdown that we're currently experiencing. But hopefully when I do discuss how the portfolio has performed over the last quarter, as well as what we've done to position it going into the next quarter, you would share my excitement about the portfolio's outlook for the next quarter. So yeah, as I said, the most important thing is looking at the smoothing lines, although it can be really difficult to think about those when we are experiencing the kind of volatility that we are at the moment. The other thing that I'm really proud of this portfolio is not only the performance, so that's not only the average annual return, but it's also the Sharpe ratio. As I said, I'm committed to having a moderate risk portfolio. So when you did sign up, that was what I promised you, and that is what I have delivered. And that sort of ranks among some of the top portfolios in the world. So let's move on to our Q3 market review. A lot has happened in the last quarter, and I'll sort of break it down and go over it step by step. So the last quarter has been a really turbulent time for investments. It was mostly dominated by the sort of actual and expected interest rate rises as the central bank continues to fight inflation. And it's really this discrepancy between the actual and the real interest rate rises where we see this volatility, because we are almost expecting interest rate rises at this point. And despite that expectation, we still see the market, kind of strongly react to that every time it happens, which is quite a sort of unique or interesting reaction, because yeah, why is it reacting like this when we are sort of expecting it at this point? The equity markets dipped in June. So the last time we met was, I think, the 19th of July. And at that point, we talked about the markets dipping in June but they very quickly rallied back up as we saw the quarterly earnings coming out. They were just coming out when we met last time. And by August, the S&P 500 was up 17% from its June low. So even within this overall decline, there are still these micro opportunities where the market is going down and coming back up. But this optimism was unfortunately quite short-lived as the central banks, both in Europe, UK, and in the US, made it very clear that they were not prepared to sort of deal with this long surge of inflation long term, and that they were going to continue to raise the interest rates. And so we saw the equity markets fall back. And by the end of the quarter, the S&P 500 had reached a new low for the year. Our portfolio, as I discussed last time we met, had moved quite strongly or more exposure to UK and Europe stocks. I think we're at about 20% in our regional exposure. So UK stocks, although they were quite a strong play because UK economy is not as exposed to tech as US, and it's very dividend heavy market. So that was supposed to give a bit of protection against the rotation that was happening this year. Although all of the UK equities also fell in quarter 3. Key events was the election of Liz Truss, who is, as of very recently, no longer the Prime Minister of the UK. So a lot of political instability in the UK at the moment with the fiscal package that she announced in September, all of it which has mostly been reversed. And that sent the sterling to its all-time low against the US dollar. Not much different in the Eurozone. In Europe, there was also further declines with the ongoing energy crisis specifically. Every sector in Europe, like in the UK, posted negative returns, with the steepest falls being in the communication services, real estate, and healthcare. And the real estate sector has been really pressured by the rising bond yields in the last quarter. In the US, from this diagram, you can see that also the communication sector was quite heavily under pressure, and this includes telecoms and media stocks, with communication services and real estate also being amongst the weakest sectors in the US. While consumer discretionary cyclical sector as well as energy sector proved to be the most resilient in the last quarter. And that sort of was expected, with consumer cyclicals being more resilient during inflationary periods, and the energy sector getting a lot of growth due to the pressure with the ongoing energy crisis. The second thing we saw a lot of news about in the last quarter is the strengthening of the US dollar. And this is largely linked to the persistent inflation that we've seen in the US over the last quarter, where the US Fed has been relentlessly hiking the interest rates, which is almost causing this hangover effect across global economies who were really willing to join the party when money was being printed so freely not very long ago. And I think it reminds me of the quote from Nobel laureate, the late Milton Friedman, who once famously said that inflation is a bit like alcoholism. You know, when it comes to printing money, the good effects really come first, and then the bad effects come later. And that's sort of what we're seeing in the economy at the moment. And it is very tempting to overdo it, and potentially overdoing it is some of the effects that we're seeing now. But the US Central Bank and the strengthening of the dollar's influence is a lot like, I would compare it to Germany's dominance of the European monetary policy, ahead of the creation of the euro, where everybody or every country is almost forced into following whatever the US is doing, because if they don't, their currency will almost certainly be devalued compared to the dollar. So everybody is running to increase interest rates, and this is almost surely sort of pushing us towards a world recession, something which I get a lot of questions about on the page and that I will address as we go through the presentation today. So with the strengthening of the US dollar, both the UK pound and the Japanese yen reached their 37 years lows against the dollar. And that's just seeing the sort of consensus that the pound at least will continue to further weaken. And with the euro, we saw the euro reach parity with the dollar, which is something that's only happened once before, and that was in 2002, just shortly after the launch of the euro. And this dollar strengthening has really been, as I said, mostly driven by the hawkish monetary policy of the Fed, as they were trying to sort of fight inflation over the last year. And market observers really expect that we'd see at least another percentage increase point, if not more, before the end of the year. So we could see a further sliding of this. But there is a slight silver lining to the strengthening of the dollar. It's a bit of a flip coin, and I'll talk about that when I'm specifically addressing how this is playing into my portfolio specifically. On a slight silver lining of what's happened in the last market, because I know it's all been a bit of doom and gloom so far, has been the neutral performance of crypto. So crypto, as you know, has been very kind to our portfolio over the last few years. We do still have sort of moderate exposure to crypto. I think it's at 6% today. And I've held on to that despite the massive drop in Bitcoin and Ethereum's prices and the sell-off that happened earlier this quarter. And I'm sort of delighted to see that crypto has managed to have this neutral performance in the last quarter, and Bitcoin's really been able to hold its ground in Q3 despite all of the negative returns that the traditional markets have posted. And we're sort of like, if we look at like why this is happening, there's been a lot of flow of capital into the crypto markets. The overall market cap for cryptocurrencies have increased by $100 billion compared to Q2. And so when we're really thinking about this, when we're thinking about this cryptocurrency performance, it's looking at the cycles of financial markets, trying to understand the cycles of crypto, which is a fairly new asset, has traditionally had this peculiar asymmetry compared to the traditional financial markets. And if we think about this, like in the traditional bull market, it usually ends with this extreme euphoria. And I think that's what we've all experienced recently. There's this short-lived parabolic surge in prices. And the faster the increase at the end, the more likely it is that, there's a chance that it's going to end in a speculative bubble. But on the other side, in a bear market, where we currently are with the cryptos, it takes a really long time for the bottom to form. It's slow, and it sort of leaves us both in the crypto and the financial markets in this consistent state of psychological fear and despair that can persist for months, which we have currently been in. And depending of like what your other investments are and what your other exposure or what your circumstances is, this can be quite stressful for the investor. And despite sort of countless attempts to buy the bottom, there's this sort of moment where it usually ends in further losses and pain for people who are trying to buy the bottom, which is why I'm not taking that approach. But at the same time, both of the bear markets and the bull markets have one thing in common, and that is the fact that we can only sort of determine their absolute peaks and their absolute bottoms in hindsight. Yeah, hindsight is a beautiful thing, especially in the stock market. But when you're sort of predicting, it's not always, as easy. So yeah, they never seem obvious when they're forming. And a lot of investors try and get these extremes, only often to end up disappointed. However, having said that, that was a long way of saying that the neutral performance from the crypto market sort of indicates to me, at least, that Bitcoin could be bottoming in Q4 this year, and that we could be entering a sort of recovery period. I wouldn't call it a full new bull run in Q1. And that's because we've seen this sort of de-linking from what's happening in the wider market. So that's our review for Q3. Then if we look specifically at what's happening in the portfolio, if you were in the call in July, you would remember that I talked about key events. One was the introduction of what I dubbed the red readjustments. And that was essentially me sort of taking a review of the portfolio. And because I had a lot of legacy positions, I accounted for what was happening in the wider macroeconomic environment and how that shift away from growth to value has impacted the portfolio in the first 3 months. My sort of anticipation at the end of last year was that that shift would happen by March, April. Of course, we now know that that happened a lot sooner, partly driven by the invasion of Ukraine, and that really impacted the portfolio and sort of led to me making these readjustments, which I went into detail in July. A key event in the portfolios, now that we've reviewed those, is that the changes have paid off. The new strategy is paying off. And that's because if we look at the previous period, the portfolio compared to the S&P 500 and the NASDAQ composite was sort of between the performance of those two, whether it was going up or down. And with the red readjustment, we were really saying that the game has changed and so does our strategy, but the goal has to change and not the overall strategy. So the portfolio is still a net long equity portfolio, but the objective has changed from absolute growth in the portfolio, which is what we've experienced for the last 5 years. And the goal has shifted to protecting the capital that we already have in the market, because we have gone into a period of slow or no growth. And so the objective there is really just to preserve the capital so that we are ready for the next recovery. And that is what the red readjustment aimed to do. And that's exactly what it's managed to do. If we look at this last quarter, although we did have losses in the portfolio, both in August and September, they were less than half of what our benchmarks had for the same 2 months. And that just reaffirms to me that the changes that we made in June, July, even though they were sort of uncomfortable, they were not what I would necessarily always do, they're paying off, and they have prepared us to be in a strong position for this new environment where we are preserving the capital. And if I then I was a bit hesitant to do this, so hopefully this won't backfire on me, but if we then do a 6-month projection, and I would say that this is a forecast only, please, this is not any guarantee for future returns, but we do a lot of forecasting in our scenario analysis to choose a scenario that will give us the best outcome. And of course, we continue to constantly, almost daily now, review that and make sure that we are still on track. But with the current focus on preservation of capital, we are seeing that if we do plot the linear trends in how the portfolio has been performing, that not only have we sort of turned around the ship, as we could sort of say, but we also anticipate to sort of push that into positive growth. That's just because we are able to, you want to, at this point, not lose as much as the stock market, so that you're ready to have capital ready to go when the recovery is coming. And that's what we have proven to have done this quarter. And I'm really, really excited about that. I don't think you'll meet somebody who's more excited and happy to tell you that there's a recession coming and they're happy to be in the stock market than me at this point after the analysis that we've done with the portfolio. The second key event that has happened this quarter, and that sort of links to the adjustment of the portfolio, is the selling and leveraging. So in July, we talked about the introduction of selling and leveraging, which is something that has not been in the portfolio. I talked about how I was doing it as part of this capital preservation strategy through hedging. And I showed this graph where I was having about 2.7% of the portfolio hedged, very low risk. We've taken a bit more of an aggressive approach on that. We're now hedged a bit more to give us more capital preservation, because we're sure that this strategy is working. but that has also given us a bit more exposure to high risk assets. And this would sort of seem counterintuitive at first thought if you're thinking about how do you give the portfolio more high risk exposure when you are in a really volatile time. One is that is what sort of leveraging adds to the portfolio. Why have I done it through leveraging? Well, as I said in July, this is still a net long portfolio. It's not becoming a long short portfolio, which means that only 5% of my portfolio is preserved for short selling. To then make sure that I get enough diversification of short selling to get the benefit of the hedging, I am not going to short sell individual stocks. So if you look at my portfolio, it's very unlikely that you'll see me selling individual stocks. And that's because I'm limiting the selling so that I get the upside without getting too much exposure. So how am I doing that? Well, that's where the asset risk contribution comes into play here. So I'm using mutual funds, specifically SQQQ, SPXU, and the UVXU, which you can see is giving us the risk contribution. And that's because, for example, the SPXU specifically is an inverse tracker. So what that means is if the stock market is going down, this is going up. And this is going up by 3x. So by buying a single product, I'm not only getting exposure to short selling, but I'm also using leveraging. And the reason I've done that, as I said, is because I did not want to use all my available cash to go into a short selling strategy, because I think we're already starting to gear up for recovery and I want to keep the cash available to get ready for that. But in the meantime, I do want to preserve the cash that is available. And so to those people who are sort of questioning, what are we doing? Is this just going to be a buy and hold portfolio for the long term? This is the answer. This is what we've done. You've seen the performance. You've seen how we've been able to preserve the capital in the last quarter. And more than that, the thing I think I'm the most sort of excited about is that I've been able to do this by at the same time, even though I'm having more exposure to high risk assets, I am almost more in control of my eToro risk score. And this comes back to sort of delivering what my copiers expect when they copy the portfolio. So as I said, it's a moderate risk portfolio. And over the last quarter, by introducing the strategy where we're using the very selective, very calculated asset risk exposure, we've actually counterintuitively almost been able to reduce the risk score in the portfolio. And that's something I'm really excited about because, yeah, it just is all the signs of a strong portfolio. It's exactly where I want the portfolio to be at this point as we're going from inflation having recently peaked and gearing up for the recession. And finding this balance has been a lot of work, a lot of late nights to sort of get us here. But having seen the performance and the capital preservation over the last quarter, it's really paying off at this point. So I talked a lot about the dollar strengthening. And if you've had a look at my portfolio recently, you would notice that I don't do a lot of Forex. So just as I want to talk about key events that have happened, I think it's also important to talk about key events that have not happened in the portfolio. And sort of getting exposure to the dollar strengthening is something that I have not actively pursued. I've put UUP here because it's a small index tracker that we have less than 0.5% exposure to at the moment. So it's almost insignificant, but it is in the portfolio. So those with a keen eye who will come back and say, oh, but you do have it in the portfolio. Yes, I do, very minimally. It's not an active strategy in the portfolio. And here's exactly why I believe it doesn't fit into the portfolio. So if you're starting to introduce strategies that are sort of trying to hedge against currency volatility, which is what we're seeing with the US dollar at the moment, those are not only complicated. And as I just showed, what we've done is by no means we're afraid of complexity with managing this portfolio. But those strategies can be really expensive. And what does that mean? Well, with stocks, as I've said previously, you expect a certain proportion of your trades to not work out. The general rule of thumb in a regular market cycles over long term is around 20%. So you expect around 20% of your trades to close without a profit, because yeah, you can't get everything right. None of us have a magic ball to peer into. On the flip side, if you're doing that with currency, Forex specifically, that is a lot lower. That if you get even 50% of your trades being profitable, that's a really successful strategy, and that's sort of unheard of, which means that you have to do a lot of trades to make sure that you get the upside. You can't just do 1 or 2 Forex trades and hope that they'll work out. You have to do high volumes to make sure that you're profitable with this low profitability rate. And so that makes it a very complex strategy to implement. And that's one of the reasons I've opted not to go for it, but that's not the only reason. The second reason is the fact that it might sound good on one side, but it's a very complex thing that is happening in the global economy. And we can get a benefit from it by anticipating what it's going to do to the companies that we invest in. Specifically, it'll put American manufacturers under a lot of pressure because their pricing will be at a disadvantage because it will not be as competitive as their foreign competitors. The other thing is also that a lot of American companies who do depend on exports or have their sales in overseas revenues will struggle in a strong dollar environment. So even though the US consumer is currently benefiting from this, the sort of broader US economy and certain specific companies within the economy may not be benefactors of this happening. And this puts even more pressure on these companies, especially in an environment where we already have higher interest rates and where the domestic consumer is struggling with high inflation. One example of this specifically, which is currently in the portfolio, but that I'm sort of watching quite closely, is Microsoft. So the company earns more than half of its revenue from foreign currencies. And so they've already put out a statement to analysts and the broader market to sort of prepare them and say that please expect that revenues will drop purely because the money that they are earning from abroad from their sales is worth less than it was. So it's this sort of flip thing. With one thing strengthening, it means it's relative to something else. So if something is strengthening, something else is weakening. In this case, we're seeing the US dollar is strengthening, but at the same time, other currencies are weakening. So that sort of brings me to the third reason why I have not included it as an active strategy in the portfolio. And that is because with the copier base that I have, I can sort of safely conclude that my copier base is non-US. eToro doesn't allow copy trading in US for equities. And so I can sort of safely assume that, like me, most of my copiers are non-US. That means they're outside the US and they have currencies which are quote unquote weakening. But the sort of advantage, of course, there are anomalies. There might be some of you here who have complicated situations. You might have some links. So this doesn't hold true for anybody. But when I'm sort of managing a general portfolio like this with a large assets under copy, you have to make the decision that sort of benefits the majority. And if the majority is non-US based holders, that means we're all coming from different currencies. For example, when I put money into eToro, I put pounds because I'm based in the UK. So I had to convert those pounds into dollars to get them into eToro and then invest in dollars on the US stock market. So that sort of means that by default, I've already benefited from the strengthening of the dollar because I bought dollars when they were lower and now it's strengthened. So the price has gone up. So my whole portfolio has actually benefited from this. So this means if the portfolio is down 20, 30%, by the sheer fact that as a non-US holder, I'm holding it in US, if, for example, the US dollar has gone up by 10%, that sort of balances out my portfolio. So if the portfolio is down 20%, but the dollar is up 10%, my portfolio in real terms is actually only down 10%. So that's another reason, the final reason why I have not included it as an active strategy in the portfolio, because I believe that my largest copier base are already getting the benefit of this surely by being non-US investors, including myself being based in the UK. And so adding that as an additional strategy, I feel will be overexposure to a single play, which is the strengthening of the dollar. So hopefully that also explains my outlook and my position on what is happening with currencies and why I'm not including them actively in the portfolio at this point. That's sort of in hindsight. Let's look at Q4 market outlook going forward. When we met in July, I had some data from a sort of market review where the consensus was around 60% of the market felt that we're headed for a recession. That number has now been updated, putting it at a probability of a global recession at around 98.1% for some analysts. So it's almost an inevitable sort of outlook at this point. And a lot of you have asked me on different questions on eToro, sort of the doom and gloom of the recession coming, investing in that point. And earlier I said I'm probably one of the most excited people at this point. Why the recession risk? What is that going to do? Well, the International Monetary Fund, MD, has sort of predicted that around $4 trillion of the global economy will be wiped out by the recession come 2026. And they're predicting that around a third of the world's economies will be having at least 2 consecutive quarters of negative growth. And that is the technical definition of a recession. So there's different recessions, but that's the technical definition that I think we're all using at this point. So that's sort of a gloom side, but I like to see the upside, because if only 1/3 of the world economy is in a recession, it means there's scope and possibility and place for opportunities elsewhere. We just have to look harder, find harder, and sort of deviate away from having a broad market strategy where up until now it's been a tech-heavy US play. We've moved away from that. We're more exposed to the US and the UK now, and we're looking even more broadly at how we can prepare which economies are going to be hardest hit by the recession, but more importantly, I think is which ones are going to be the fastest out of the block for the recovery is the most important thing that we're analyzing and tracking right now. And I think central banks around the world have been, as I said, raising interest rates with a degree of synchronicity that we haven't seen in the last 5 decades. So there's almost this trend that we can expect, definitely likely to continue into next year. And we're also currently expecting that the current interest rate increases will continue on its current trajectory. So we could almost say that the worst is not over yet. I'm predicting that we haven't bottomed out at this point yet. And that's purely because we can expect central banks to continue raising the global monetary policy rates by almost probably like 4% through 2023. And that's sort of consistent with our expectations of saying that bear markets tend to last between, you would see different numbers, but probably 6 to 18 months. I recently predicted that we're having an L-shaped recovery, which means we've had a steep cliff down and will sort of stay in this period for a bit longer, which means our bear market would sort of be pushed towards the longer end of that range into the 18-month period. And we can expect swings and volatility in the market to continue until the Fed has sort of put down their tools and said, mission accomplished, we've been able to get inflation down to the levels that we wanted. And I expect that to be likely somewhere in mid to late 2023. And so all my base case analysis has penciled in a recession in the US, Europe, UK at this point. And at the same time, having said that, I also expect some surprise on the downside of inflation over the coming 12 months. And if we combine the sort of like weak growth with low liquidity and increased interest rates in the short term, you're likely to feel quite doom and gloom, rightfully, as a lot of you have said, about the global markets. So your question might then be, what am I doing to prepare for this? And the answer is quite simply, this is a growth portfolio. It's always been invested predominantly in growth stocks. Why am I holding on to that strategy at this point? Well, one is if we look at the equity performance following prior inflation periods, on average, they have a 10% return in the 12 months following the peak. So all consensus at the moment is that inflation has already peaked. And so not always is it positive. There are instances where it has been negative, but the majority of the periods have been positive. In the sort of climate of inflation hopefully passing or having peaked, let's say, value stocks do tend to outperform growth stocks in inflationary periods. But as I just said, inflation has already peaked. And so suddenly now, like throwing out all our growth strategy and going into value stocks or becoming at least a 50-50 portfolio means that we have missed the last change. And we'll probably miss the recovery as well. And so there's no point in doing that, especially if you consider that with the recession risk growing, we've almost concluded that there's a very high chance of recession. But in this scenario going forward that I just sketched out, growth stocks typically do tend to have a performance edge. And that's mostly because they're have the potential to outpace the slow growth that is happening in the macro economic environment, which value stocks don't necessarily give you at that point. So we do have some value stocks in the portfolio, but again, I would reiterate that this remains a net long growth equity portfolio. If we do anything else or introduce anything else in the portfolio, it's mostly as a hedge to preserve the capital rather than the fact that we've suddenly changed the investment strategy. And that's really important to understand. The investment strategy is still consistent, although it is adapting to what's going on in the economic environment. So again, if we just sort of look at this, as I said, we can't do this, we can only do this in hindsight, but if we look historically at returns during recessions, before recessions, and specifically after recession, they're almost always with 82% of the time, they're positive. But that will come down to riding out this very bumpy phase as the economy is transitioning from high growth to growth slowing down. And since it's still in its early phases, as I said, inflation has just peaked. Investors may tend to sort of overestimate the speed of short-term dislocation and how long the economy might take to normalize, and often underestimate the magnitude and duration of the long-term components of inflation, which will still be with us for a while. And we can still expect to continue feeling the Fed interest rate hikes that we will continue to see into next year. So that's sort of my market outlook for the next quarter. So I don't see any questions yet. So I'm just I'll assume that I'm sort of answering them as I go, but I will speed up a bit to leave time for questions at the end. So this is our asset allocation positioning based on the market outlook that I've just discussed. So in Q3, we had sort of increased our positions in most of our positions. Going into this quarter, we've drastically reduced our cash position. So when we met last time, about 40% of the portfolio was in cash. That has gone down to about 20% at the moment. That's partly because I'm starting to slowly go back in strategically with specific positions, but it's also because what I discussed about the preservation of capital and slightly larger positions in the leveraged shorts, which is giving us hedging at this point until we're very certain that you know, we have reached the bottom and that we have made a turn. So in general, going forward, the slide hasn't changed. I'm sorry if you've seen it before, but I will continue to do my scenario forecasting. I think today I've shared that a lot more with you than I ever have. Please don't make me regret it, but I will continue to do my different scenario forecasting to sort of maintain a moderate risk score as we preserve the capital, because I think that's the most important thing. As I've said before, if I suddenly start to do all sorts of funny things in the portfolio because I'm feeling the pressure from, you know, people commenting, you should really get worried, because that means I've lost the plot as the head of this sort of portfolio. So I'll continue to do the forecasting, I'll continue to do the dynamic readjusting, but more importantly, I'll continue to communicate that with you with more transparency. And in the meantime, I ask you to, as always, expect the volatility, as I think I've sketched a very sort of realistic outlook of why we should be expecting more volatility in the next quarter, definitely, and maybe into early next year, but also why we're not currently in a high return phase of the economy. But we are in a very strong position to take advantage of that once the recovery you know, kicks off. What I would ask you to do is remain disciplined and patient with me. Hopefully the long-term returns of the portfolio has sort of shown you the importance of having discipline and patience over the long term when you are investing in the stock market. And then I'll also ask you to review your portfolio. I get some questions about stop losses. I don't use stop losses, but I do closely monitor the positions and close them when they have gone outside the remit of the portfolio for an extended period of time. And so I know a lot of you, because the market is down, my max drawdown has gone from 20% to close to 35%, which means those of you with very tight stop losses, they may have been triggered. So I would ask you to review those based on your sort of situation. I am actively monitoring them. So on a copy position, they would not necessarily be needed, especially in a volatile time like this. It could result in unnecessarily triggering a stop loss if you do put it very close. But again, it's up to you to look at your individual situation of how you want to use that. And then just a few final notes before I get onto the questions. I see there are a few questions coming in now. I would remind you to continue depositing. I am doing that. If you have looked at any of the recovery from the last recession, they've been very positive. And so, you know, people often talk about the 2007, 2008 financial crisis and the recovery and the exchange of wealth during that period. I think your largest regret in any recession is if you were not invested during that period. And so that's why I'm specifically very excited about this period. It's not often that as an investor, you get multiple recessions within such a short period of time. And it is an opportunity for exceptional growth. It is an opportunity for taking advantage of the recovery. So yeah, second reminder is about the mailing list. We're starting that back up. Some of you may have already been signed up for it. That has sort of, apologies from me, have sort of died down when the markets really got busy. But I now have a team and I have help, so I can focus more on the stock markets as well as keeping these other things going. So if you want to sign up for it, either just scan the QR code here or go to my Linktree. And then finally, you're all invited. If you haven't been able to tell yet that I'm excited about the recession coming, I'm hosting a session with eToro's Sam North about how to prepare your portfolio for a recession. I'm going to be interviewing him. I'm really excited about that, to talk to him about that. So do join us for that next week. It's a short session, it's only half an hour. And then I'm also looking at launching one-on-one meetings within the next quarter. So look out for announcements on those as well. It will be going out on my mailing list. And so with that, I will come on to the question section. So there's a question about whether I expect the market recovery to be before the end of the year and what my estimated performance is for the portfolio for all of 2022. So at the moment, I think, of course, eToro is all about transparency. There's no sort of making up the numbers here. I think the portfolio is, when I checked this morning, down 32% for the year. Based on when you copied me, that may or may not have put you in a very uncomfortable position. So if you copied right at the beginning of the year, you didn't have any of the benefit from the 40 or 60, 40 in 2020, nearly 20%, so 60% growth in the last 2 years. If you have been with me for a long time, like me, you may not even feel this. It's just a blip in the long-term nature of the portfolio. So in terms of that, I don't expect the market to recover before the end of the year. As I have said, we are still expecting the Fed to increase the interest rates into next year. And so I only anticipate the recovery to start happening towards early, mid, late next year. It's really difficult to say. But one thing is I'm almost sure about is that we are going to see an L-shaped recovery. So we are going to see a little bit of a longer period before we see a return. It's definitely not going to be like the recovery we saw in 2020. And that might be where a lot of you are sort of getting despaired, because in 2020, the market fell very quickly on the announcement of the pandemic and then recovered very quickly as a lot of money flooded into the market. Of course, this time it's a lot more complex. There's a lot of other things at play. And so we don't expect the recovery to be as sharp and as fast as it was last time. However, that does not mean that there isn't opportunity for preserving the capital during this period. If anything, I've shown you the graphs of positive returns during and after recessions. And so it's just that you sort of have to change the objective and the outset of the portfolio. So previously, where we could be invested in a broader market because everything was growing, we are now having to be a lot more strategic about the sectors that we are investing in. So for example, if we're talking about an L-shaped recovery, I'm sort of becoming more and more bullish about basic materials, for the simple reason that in the beginning of high inflation or recession, you'll see households sort of holding back on their expenses. They're feeling that initial pinch, which is what, you know, the media is reporting about a lot right now. But then as this slowdown continues for a prolonged period of time, and this could be a couple of months, you know, as I said, when we're in this stressed psychological period, it could feel like forever. Over the long term, the real estate market will sort of see a slowdown because interest rates are going up. So people are simply not buying houses. But what that means, for example, is that instead of moving houses, once people get over this initial shock of the inflation, there'll be, for example, some repairs to their houses that they have to do. People will be more likely to do it, to DIY. And so basic materials like wood, steel, plastics will sort of continue to be strong plays in the recovery period. I have another question about whether I'm using technical analysis in my decision or I always go with fundamentals. So as I've said before, I use a combination of both. I rely on fundamentals to sort of point me in a direction. I don't think either of these can sort of happen in isolation. So I'd say I use a hybrid. I use fundamentals to sort of make sense of the macroeconomic environment, but then I guess you could call it technical analysis, because I use machine learning algorithms to help me identify entry and exit points once I used fundamental analysis to identify either a specific sector or a specific stock. So that's sort of the use of both. I sort of just like to get the best of both. And there's a question about how often and how much percentage-wise shall we add to the portfolio each month and year. It's a difficult one to answer because it is up to everybody's sort of individual position. I used to add a fixed amount every month just because I could plan for that in my income. So that wasn't necessarily a percentage of my portfolio, but it was a percentage of my income. And I just did whatever, I wanted to get into the stock market. I think it was about 10%. And I continue to do that on a monthly basis. That gives you the advantage of dollar cost averaging. Of course, you're not only getting the advantage of buying at different points, but at this point, exchanging at different points if you're coming in with non-US currencies. So I usually recommend and also implement a regular monthly, usually, because that's convenient for me, addition to my overall investment portfolios. And so if you're able to do that, especially in this inflationary period, I know it can be difficult, but you will definitely not recommend it. I recently read a study where they showed a 26% return on investments that were put into the stock market during recession. So there's definitely a lot of upside. And I, for one, believe that the only regret you might have is not adding to the stock market at this point. And so that's why I'm continuing to add. And also, it's been my investment philosophy since the start of this portfolio. Those of you who have been with me for a long time will remember that we used to add together monthly. And so I continue to encourage all my copiers to continue doing that. And so with that, I'm just mindful of time. We've reached the 1 hour. I've gone through all of the questions that you put in the Q&A section, and I've also hopefully covered all of the questions that come on my eToro page. So thank you so much for joining my quarterly call. I hope that despite everything you read in the media or what you're seeing your current portfolio to be, you can start to share some of my excitement about why potentially going into a recession is quite exciting from an investor's perspective. And I hope that you will continue to join me on this journey. And I look forward to seeing you at my next quarterly call. Have a good evening or day wherever you are. Bye.